Nigeria's central bank has increased foreign currency trading positions for commercial banks, but is this too little, too late for the Naira? We'll be exploring that question live from London in the next 30 minutes, but there's plenty more in the pipeline as well. Here's what's coming up. A fall in prices and a new tax regime threatens profits in Zambia's copper industry. And after more than a decade of absence, Egypt makes a return to the World Economic Forum in Davos. Now then, let us begin tonight in Nigeria, Africa's biggest economy. The central bank over there has increased foreign currency trading limits, or rather positions, for commercial banks to 0.5% of their total capital base from an earlier cap of 0.1%. Now, this latest rule change aims to increase dollar liquidity within the interbank market. Liquidity conditions have deteriorated as the local Naira currency has fallen to record lows, as dollar inflows from foreign investment and a variety of other sources have dried up. Now, the CBN says funds sold to commercial lenders will be used to fund letters of credit and other invisible trades, but they should not be resold to forex bureau dealers. Nigeria currency dealers agree to hold trading if the currency falls by over 2% within any given trading day. They fear the Naira could head to 200 to the greenback, creating extreme volatility and adding to deteriorating liquidity conditions as well. Now let's get up to speed with the latest developments on the dollar-Naira trade with Kiri Blackintop. She's live in London right now. Kiri, nearly 3 months after this 8-month devaluation, the Central Bank of Nigeria has consistently defended its target, saying it's appropriately priced. Does anyone still believe that?
Well, the central bank is certainly battling to keep the currency in that new trading range. Since devaluation, the Naira continues to trade outside the CBN's target rate of between 160 and 176 to the dollar. Today, though, the Naira rebounded from record lows earlier in the week, and that was on the back of action from the CBN to increase forex trading limits and sell dollars to commercial lenders. In the previous session, dealers had agreed to halt trading if there was more than 2% intraday slide in the currency. Now, the reason it had plunged to those record lows is because dollar inflows from foreign investment and other sources had evaporated. Now, the fear among dealers is that the Naira will head to 200 to the dollar, which could trigger extreme volatility and add to the worsening liquidity conditions. But the Nigerian central bank governor, as you said, keeps on insisting that the currency was appropriately priced and warned that the bank won't tolerate speculative attacks.
Indeed. However, given the position of its foreign currency reserves, defending the Naira by direct intervention can't happen forever. In traders' views, what would it take to trigger another devaluation in the Naira?
Well, at the moment, the CBN is tearing through its foreign reserves after being forced to step in and sell dollars in the market. Economists say this policy reversal could be hurting the central bank's credibility, but is a step in the right direction to improve spot Naira liquidity. But these kinds of policy changes are really just delaying the inevitable currency devaluation, and that's according to analysts. Some had predicted the central bank might announce fresh measures when it met on Tuesday, and that would mean the second currency devaluation in as many months. But as we know, there was no mention on Tuesday of further moves to the Naira's ban, but falling oil prices coupled with expectations that the United States will soon raise interest rates has analysts forecasting a shift after the elections, which are in just a few weeks' time.
Indeed. Finally, Kiri, given how volatile the currency has been so far this year, how does this change the outlook for headline inflation in Nigeria, at least in the short term in 2015?
Well, at that CBN meeting, the central bank governor said inflation remains within its target for the time being, but it's certainly facing a tough road ahead. The governor cited risk factors that included security challenges, and that was relating to the ongoing threat from Islamist militant group Boko Haram. Now, sustained attacks across the region are having a flow-on effect for the country's agriculture sector, with continued disruptions to farming, and that's further unsettling the outlook. Also adding to those inflationary risks is that collapse in global oil prices, which is hammering the economy and the currency. And that's because Nigeria, which is Africa's top oil producer, isn't an OPEC member, so it has to make its price more competitive at a time when oil is hovering above the $50 a barrel mark after plummeting almost 60% since June last year. And one of the other major factors, as I mentioned just now, the prospect of a US interest rate rise. And because Nigeria relied so heavily on the strong US dollar, a rate hike is likely to put further pressure on the Naira. And that's a problem we're seeing in many emerging markets.
Indeed. We'll have to leave it there for the time being. That's Kiri Blenkinsop live in London. Now, over the last decade, many an African country has focused on expanding access to financial services. But the results across sub-Saharan Africa, to put it mildly, have been enormously varied. Take, for example, by end 2013, just a quarter of Kenya's adults had absolutely no access to any formal financial services. That was down from about 39% all the way back in 2006. Now, contrast those numbers with those from Burundi, where nearly 3/4 of the entire adult population had absolutely no access to the entire financial system by end 2012. Or Nigeria, Africa's biggest economy, 40% of the adult population with no access to formal financial services of any kind. Now, cracking this puzzle of how to extend financial inclusion is something that the Mastercard Foundation is now turning its attention to, with a $50 million fund willing to invest in innovative ideas to that end. Earlier on, I spoke to Anne Miles, the Foundation's Financial Inclusion Director, to get a better understanding why the Foundation would want to get involved in solving this problem.
Well, we've been looking at where are the biggest gaps in terms of access to financial services across particularly in sub-Saharan Africa, which is really the focus of the work that we do in financial inclusion at the Mastercard Foundation. And we saw when you look at the population of people who are most financially excluded, it's those who are in rural areas and oftentimes primarily engaged in some kind of agricultural related activity. So it could be farming or it could be some business related to farming. And if you look at the level of financial access in agricultural or rural areas, it's much lower typically than what we see in urban or semi-urban areas. So there's that one challenge or frontier. Second frontier is really around access to capital. So if you look at, again, what are the financing needs of smallholder farmers and even higher up sort of in that value chain, there's huge deficit in terms of capital available to help these farmers sort of invest in how to make their farming more productive, how to improve their yields, and also how do they invest in enterprises around the farm.
And this also has a gender dimension to it, doesn't it? Because most of the farming in sub-Saharan Africa is done by women.
That's correct. Most of these smallholder farmers are women. So we saw an opportunity here, which is why we developed this fund for rural prosperity that could really look to finding ways that are both innovative but also taking innovative ideas to scale that really could reach through financial services and also training this particular, this excluded population.
The most public goal of this entire idea is to actually get 1 million financially excluded persons into the formal financial system.
Right.
But beyond that, what other goals do you have in mind for this in terms of, say, deposit rates, savings rates, and so on and so forth?
We haven't articulated it at that level yet. That's something we'll be thinking about. We have, we've brought on board something we call a learning partner. This is an organization that will help us track all of the data that we receive through each of these projects that get approved to help us better understand the ultimate impact of this. So we're looking beyond just access to financial services, but how are these services used by smallholder farmers? And then how does it affect their household income? How does it affect their household conditions? And is it helping them move, take steps out of poverty?
Let's talk about sharing infrastructure, because in most cases where you've got financial inclusion being aggressively pushed, like Kenya, for example, you ended up with situations where either banks and mobile service providers, after a bit of bullying from regulators, end up sharing infrastructure at some point. Either it's agents who have to be shared between one party or the other. To what extent can this lower the cost of getting these services out to the rural poor who need it the most?
I think what we're hoping to see, probably especially through the innovation window, and I think this is where maybe Kenya has an opportunity to show its stuff, is models that really demonstrate this opportunity to extend financial services at scale, but also reduce the cost. And we know there are challenges around the cost, that we know there's some tension between the cost structure a mobile network operator imposes on a financial service provider. So we hope, especially for smallholder farmers and the rural poor, that innovators will continue to think, how can I disrupt? How can I move through these models? And we don't really know what that will look like.
My conversation there a little earlier with the Director of Financial Inclusion at the MasterCard Foundation. Quick run through the markets here for you. Broad spread of gains, depending on which market you're talking about, except up in Nigeria. That was down by about a quarter. Day 4 of gains at the JSE All-Share Index. That was up by about half a percentage point or so. Some interesting numbers coming through on the Rand as well. We'll cover that in a little more detail when we talk about the Euro area quantitative easing program a little later in the bulletin. We'll be looking at tales of darkness in Libya as power firms flee fighting from militants. And after more than a decade of absence, Egypt is back in Davos. We'll be live in the Swiss ski town a little later. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast-changing African business landscape. We take you where the business is happening.
Global Business, weekdays at this time on CCTV Africa.
If it's early January, then you definitely know Davos will somewhere be on your news agenda. World and top business leaders arrived on Thursday for the second day of the World Economic Forum in the Swiss Alps, just hours before the European Central Bank announced a plan to buy government bonds, resorting to its last big policy tool for breathing life into the flagging Eurozone economy and to fend off the spectre of deflation. Now, the ECB unveiled a large-scale program of quantitative easing, effectively printing money to buy sovereign bonds, although we are simplifying quite a bit here, despite opposition from Germany's central bank and concerns in Berlin that this could allow spendthrift countries to slacken the pace of their economic reforms. The ECB has already cut interest rates to record lows. It started buying private sector assets and it's funneled hundreds of billions of euros in cheap loans to banks, all in the hope that they will then lend the money on into the economy and stimulate growth. So far, that hasn't worked. Despite a backdrop of economic gloom, some businesses do see an opportunity.
Generally, globally, economies are beginning to recover. Yes, there's been some downgrading in prospective growth rates, but growth rates are still improving, led by the US, which is showing strong, robust growth across the markets. There's lots of demand from corporates for space across all of the sectors. There's lots of equity looking to invest in real estate because with interest rates in bonds at 1% and 2%, real estate looks attractive, and there's a lot of debt available to help finance those deals. So across the piece, real estate markets look healthy for the next 1 and probably 2 years at least.
For the very latest from Davos, Jack Barton joins us now from the Alpine Ski Resort. Jack, what impressions are you getting from over there of the ECB's move to quantitative easing in the European Union? Do CEOs over there believe that this will improve the competitiveness, at least, of European exports?
Well, they're nowhere near as united on the issue as Europe's markets today, which were all up on the news. It's a lot more divided here. Now, as you mentioned, the idea is to put more money into the banks in order that they will pass it on to loans to businesses and consumers. But speaking today at the World Economic Forum, German Chancellor Angela Merkel said there's already plenty of liquidity in the Eurozone. That's not the problem. Many other delegates here agreed with her, saying there is a lot of money here. It's just people are not consuming. They're nervous about the economy. They want to keep their money stashed away, and pumping lots of extra money into the economy could just make them more nervous. Even the deputy head of the International Monetary Fund said really structural reform is the only game in town at the moment. But of course there were plenty who thought this type of stimulus was a good idea. Among them Matteo Renzi, the Prime Minister of Italy, who said it could send Europe in a new economic direction. He meant that as a positive thing, of course, because the bloc is still mired with very high unemployment, very high debt and very low growth. And of course, in December, it slipped officially into deflation.
Indeed, and at the same time, some news coming out of the markets right now. The euro is at multi-year lows against the American dollar. Let's move away from monetary policy, however. Bill Gates, earlier on, he argued that the response to the Ebola crisis should have been a lot faster. What else should have been done differently in response to the epidemic?
Well, nobody is in disagreement with Bill Gates. There was a big panel on Ebola today, a lot of discussion. Everybody agreed that a lot more needed to be done at a lot faster speed. But we also heard from Peter Peart, the Belgian virologist who was on that team that first identified Ebola back in 1976. He's still working on the vaccine program. He and some of the other delegates were really pushing for a much bigger preemptive approach or proactive approach, saying let's not wait for another disaster to happen. And he said another disaster will happen, and the risk is in the emerging and the developed world equally. He said programs need to be put in place by governments that can be rolled out quickly when there is such a disaster. He said also a lot more needs to be done to build trust between the big international organizations which assist in these situations and sovereign countries, which often feel their sovereignty is actually threatened with these big organizations rolling in. And he also said a lot more needs to be done in terms of vaccination. So preemptively having an emergency response plan and trying to put a health policy in place that prevents these sort of outbreaks in the first place. The good news, he said, is that he believes an Ebola vaccine is coming in a very short period of time.
Indeed, we'll have to leave it there for the time being. Thank you very much for those insights. That's Jack Barton keeping an eye on events in Davos there for us. We're still in the Alpine Resort, though. The Egyptian President Abdel Fattah el-Sisi is attending the World Economic Forum. Early on Thursday, he encouraged business leaders from around the world who are attending that to invest in Egypt. He argues that the country and the authorities over there are now committed to opening up the economy. Yasser Kim filed this report examining Egypt's pitch to potential investors at the forum.
Egypt is embarking on a major overhaul of an economy severely damaged from 4 years of political turmoil. For Egyptian President Abdel Fattah el-Sisi, the World Economic Forum is an opportunity to garner support for the reforms being undertaken since his election.
President el-Sisi assures many times in his speeches that Egypt is seeking to solve all the problems of the investors, because after the 25th of January revolution, there's many problems facing the foreign investments, and Egypt now are keen to keep the old investment at first, and then to promote for the new investment. We call for the participant to participate in the Egyptian Economic Conference, which will be held in the mid of March.
Egypt is currently suffering from a lack of income, mounting debt, a dwindling currency and low foreign reserves. El-Sisi will need to attract investment into the country to fix this. Meanwhile, politics will also be high on the agenda of the Davos talks.
Political issues, especially how Egypt are combating terrorism, and how if Egypt combat the terrorism, this will lead to the stability of the whole region and the whole world, maybe Europe especially.
In spite of the economic crisis, ratings agencies raised the country's standings to stable, and the IMF described Egypt as a huge potential for investments. El-Sisi will play this card in his talks with investors. The World Economic Forum in Davos this year is seen here as crucial to Egypt's economic development. So much that El-Sisi has become the first Egyptian president to attend the summit in the last 11 years. Yasser Hakim for CCTV, Cairo.
Now, Zambia's recent economic growth has been powered by its vast copper resources and the earnings off that. However, given the slump in copper prices and a variety of domestic factors, that party is effectively over. Higher mining royalties announced last year could cut off new investment in a sector which, as Farai Makutuya now explains, is reeling from plummeting global prices.
In its 2015 national budget, Zambia's government introduced a single-tier tax rate on all mining houses. The move left the industry up in arms, claiming it didn't take into account production costs and would hurt the sector. Zambia's Chamber of Mines estimates the damage to amount to job losses in the region of 12,000, production losses of 158,000 tons in 2015 and 1.1 million tons over the next 5 years, export earning losses of $1 billion in 2015 and $7 billion over the next 5 years. Negotiations between government and miners are yet to yield any concessions. However, both frontrunners in the country's presidential election have said they will review the tax should they win. While that offers a ray of hope, plummeting global prices of the base metal, most recently selling at $5.35 per ton, its lowest since July 2009, have dealt the beleaguered industry yet another blow. This week, the Chamber of Mines said more than half of the copper mining operations in the country were losing money as a result of the depressed prices. The situation will remain unpredictable going forward. It's an alarming situation, given that the industry accounts for 86% of FDI and 80% of export earnings.
That's why we've always championed the issues of diversification of these economies, because if we are going to rely on, we are going to be mono-economy for a long time. We are going to continue crying on these issues. Let's attract investment in other areas, a lot of areas where we have potential as a country.
Agriculture and tourism are tipped as the industries that could bolster non-mining revenue. Farai Makutuya, CCTV, Lusaka, Zambia.
In addition to its security and its political crisis, Libya now is facing a power crisis. Families over there now have to endure serious power cuts amid the ongoing turmoil in the North African oil producer. Service providers have fled the capital, Tripoli, citing safety concerns. The internationally recognized government of the Prime Minister Abdullah Al-Thani has also relocated away from Tripoli to the east of the country. And this happened after an armed faction known as Libya Dawn took over the capital and then went ahead to set up a self-declared National Salvation Government. Here's Leslie Murungu with more.
Fuel shortages and damage to the electricity network caused by fighting between rival militias has meant that Tripoli's government and electricity companies have struggled to meet demand. The Minister of Electricity of the National Salvation Government blames the power shortages on lack of security in the country.
The reasons behind the electricity shortage are the security conditions and the instability the country is undergoing, and that has resulted in damaging some power lines in several cities. Also, maintenance teams are not able to do maintenance works in areas that currently witness conflicts.
The shortages have forced residents to seek alternative sources of power, and as a result, there has been an increase in generator sales.
People are forced to buy these generators that can provide them with electricity up to 6, 7 or 8 hours, especially as we are in the period of students' exams. And families who have children are forced to buy them so that their children are able to read.
The persistent power outages have caused untold frustrations to many Libyans.
Electricity is really important in the house or at school or at work, and you cannot move without it. Even if the traffic lights are not working, you can notice how much disruption this causes on the street. Electricity is the foundation of life.
The security situation has not just reduced the capacity of the government to act, but it has also forced companies that produce electricity to leave.
The excuse of instability and the lack of proper security conditions has led to many companies leaving the country and resulted in both halting the projects and a severe shortage of electricity in terms of sufficient production to make up for the shortfall.
4 years after a NATO-backed uprising toppled Muammar Gaddafi, Western powers fear that Libya is sliding closer to civil war. Last week, the United Nations held talks in Geneva with some of the factions, including those representing Thani's government and allies of Libya Dawn. But the Tripoli government and its assembly insists that talks should be held in Libya. Leslie Mirungu, CCTV.
Quick run through commodity prices here for you. There was a bit of a rally above $50 a barrel on Brent crude on ICE a little earlier in the day. That, however, did fizzle out rather spectacularly, down past 48 to the barrel on Brent crude futures. However, with regard to agricultural commodities, Cameroon's cocoa bean exports were up 9.5% year on year by the end of December. There's an interesting supply block that's happening all the way in Cote d'Ivoire, the biggest producer. We'll keep tabs on that story and bring you updates later on tomorrow. Speaking of Cote d'Ivoire, bakers are changing their ways as far as healthcare is concerned, especially given the Ebola outbreak in West Africa. We'll tell you how the two are linked shortly.
Having lived in 4 different African countries and with a diverse background, I cherish the personal as well as professional experiences I've had across the continent. It's this understanding of the place I call home that drives me to tell stories about its people, its needs, present and future.
There's just so much happening in Africa in terms of the way forward and development. It only brings positivity.
My place at CCTV Africa is about creating awareness around the realities of a continent that is indeed complex, vibrant, and has great potential.
Africa is my home. How it prospers, the challenges it faces, its people all matter to me because this is my future. I'm Famida Miller and I'm a reporter and anchor at CCTV Africa.
Welcome back to the program. You're watching Global Business Africa. A ban by Cote d'Ivoire's Federation of Bakers and Pastry Producers on the sale of bread in the open market without proper hygienic measures has been met with mixed reactions in Abidjan. The Ebola outbreak in West Africa has amplified concerns about the quality of food production in the country, and that's our focus on grassroots tonight.
Traditionally, most of West Africa, including Cote d'Ivoire, bread has always been sold in open markets, street corners and neighborhood shops. Delivery used to be done in plastic or paper wrappings. But with the rise of communicable diseases like Ebola in the region, there is concern over the manner in which food is handled.
The
traditional way to deliver bread was requiring young people to carry the bread to potential customers. Today, the government has decided to put an end to this kind of delivery. This decision doesn't make anybody happy, neither the customers nor the bakers, except those who have a retail outlet policy instead of a delivery policy.
The regulation has been set to stop errand bread delivery and to bring people to come and buy their bread in bakery shops. If there is indeed bread delivery, it must meet hygiene standards with a specific vehicle to do the job.
The ban, which came into effect in December last year, has seen bakers change the way they do business in order not to be caught on the wrong side of the law.
We always put on gloves before serving our customers at the counter, which must be the bakery's image.
The Federation has always instructed those involved in baking to obtain permits from the mayor. This is after hygiene standards required for business are met. Noel Makugu, CCTV.
Right then, on the day when the euro fell to an 11-year low against the American dollar, that's it for this edition of Global Business Africa. Thank you for watching. We'll see you tomorrow. I'm Raman Yan.